There are an unlimited amount of risks in the financial system today. Many have begun to point to corporate debt as one potential source or trigger for a future event. It's out of control but ignored by most. Only time will tell if this is the epicenter of a future calamity. You came here for the truth, so let me unveil that for you. Today we are going to look at corporate debt, we're going to look at CLOs, we're going to talk about derivatives. The majority of investors today have absolutely no idea what this is, but as long as they continue to invest with the market, then they feel confident. Well, they should also know what is actually going on behind the scenes, at least one layer deeper than what they are told in the mainstream, to be able to understand where they are putting their hard-earned savings. Most will not learn, most will suffer the consequences. Let's begin. You're looking at this big jumble on the screen. This is a depiction of a CDO, or a collateralized debt obligation. This is basically the same as a CLO. It's the same as a mortgage-backed security. It's a derivative. You take an existing product, in this case what they're showing you is a residential mortgage, and that gets bundled up and wrapped this way and put that way and bent here and pushed there, and they make it into a beautiful present for investors to purchase. This was realized after to be one hell of a big mistake. The amount of CDOs today are less than the amount that was there at the peak during the financial crisis. However, what we've seen instead are other derivative products like CLOs, collateralized loan obligations, that have grown in its place. So we have not had the same exact thing occur, but you change it a little bit, one here or there, and you create a new product, and it is then ignored by the regulators. We have ourselves a problem. 85% of all leveraged loans, one of the most risky types of corporate debt, are now, quote, covenant light. That means that they lack traditional requirements for companies to maintain certain financial benchmarks that protect the investors who pay for them. Do you see a problem with that? Leveraged loan quality is thus at a record low. This is something that they would ignore over and over again. The Bank of England Governor Mark Carney compared it to the subprime crisis of 2007. So we actually have some level of acknowledgement, though in general, this is ignored. The leveraged loan market has set a new record. The quality of investor protections in this market just hit a new all-time low. So this can go on for months, this can go on for years, but when we have a problem, all of this will unravel. Presently, the value of CLOs outstanding is higher than any asset-backed securities, including auto loans, student loans, credit cards, and other. You could see here the CLOs representing the orange portion of this pie chart, 42%. So you know that investors are picking them up and they are loving every minute of it because it is such a high-risk investment. They are getting returns. It's hard to get returns for a lot of these big corporations, but they can do so when they take this extreme level of risk. Within that Forbes article, they just give you a list of the different corporations from Goldman Sachs, JP Morgan, Barclays, all the big names, just showing you the amount of money that they have invested in these extremely dangerous assets. And I use the word asset very loosely. Global volume of Cov-Lite leverage loans in billions of dollars, and you could see the extreme rise since the financial crisis to present day, how much these investors are vacuuming them up like never before. In Europe, it's the exact same thing. You could see this for yourself here on the chart. Leveraged loan volume has been increasing dramatically, exceeding what was there during the financial crisis. The latest data from May 2019 show that 80% of those loans are covenant light. This means that in an economic downturn, when companies start to pay late or default, lenders have little to protect them from losses. So we are setting ourselves up for failure once again, but people really don't care because what are they looking at? Unemployment rates. They're looking at all of these factors like inflation and other silly things and not actually attending to where the risks are today. They simply look at the Federal Reserve and what they are saying. Everything is safe and sound. Okay, I believe you. I will continue to put my head in the sand. According to S&P's Global Market Intelligence LCD, the U.S. leveraged loan market as of the end of May 2019 is $1.2 trillion. This is a 115% increase since 2007. You could see it here on the chart. Now, while this isn't the biggest thing ever, we're not talking about quadrillions of dollars worth here. It doesn't matter. If you look at the subprime mortgage market during the financial crisis, it wasn't quadrillions of dollars either. So we do have a potential catalyst for a future event. Fortunately, we are still a couple years away from when a significant amount of these loans mature. At that stage, if companies are less creditworthy or if we're in a recession, companies will struggle to renew or refinance those loans. That's pretty obvious here. It shows you here that this is several years down the road. So again, nothing to worry about, right? So according to Bank of America, they're saying the one troubled spot, nothing else, everything else is great, but the one troubled spot is the leverage loan market. It'll be ugly for those companies if the economy slows down and they can't carry the debt and then restructure it and then the usual carnage goes on. By the way, Bank of America, heavily exposed to this. We should worry about that. In this article here, there's much more detail in it. I just wanted to show you the basics today and hope that you just realize what is really going on with the CLOs, with the derivatives, and how big this has grown. One last thing before I end the video. Leverage loan and CLO markets are very opaque. In order to figure out how much banks are holding in these two financial products, you have to look at each bank's financial statements or regulatory call reports, and to figure out the risk weighting of their securitizations such as CLOs, you have to analyze the bank's Basel III Pillar 3 disclosures. Even harder is to find how much insurance companies, pensions, university endowments, business development companies, private equity, and non-banks are holding in leverage loans and CLOs, and granular data for how exposed banks are to those non-banks is practically impossible to find. Congratulations, we set ourselves up with some sort of casino garbage that is going to collapse at some point. Is it going to happen today? Is it going to be happening tomorrow or next year or 5 years or 100 years from now? I can't tell you that information, but what they're doing is taking maximum risk, and all of these companies like Bank of America, Goldman Sachs, JP Morgan, they're going to be getting the bailouts. They're going to be screwing you over, and we're going to see the same thing happening over and over and over again, and every time they get the upside, you get the downside, and people take it. They sit there and take it because they don't know what to do. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like, you're supporting me. Click one button. That's all I ask. If you want the financial education you were not taught in school, these two books have everything you need. Top to bottom, A to Z, you get all the details that you need to know about the financial system, how it works, what you can do. It's all located in these two. Check out the link in the description if you want the audiobook. That's available at themoneygps.com. If you haven't seen this video already, definitely take the time to watch it. I really break down some information you need to know. Click on it and I will see you there.